Welcome to The Explainer. You've probably seen the headlines, right? Regulators step in to ban some kind of speculative trading, all in the name of creating stability. But does it actually work? Or does it just push all that risk into the shadows, maybe even creating more chaos? Well, today we're going to find out. Let's start our story back in late 2021. Food prices were on the rise, and India's market regulator, SEBI, decided to act. They banned futures trading, those contracts to buy or sell something at a set price in the future, for key things like soybean and palm oil. The idea was to protect consumers. But the real question is, what happened next? And yeah, this is the central puzzle we're tackling today. Did the fundamental desire to trade, to hedge against risk, or to chase a profit just evaporate with the stroke of a pen? Or did all that activity simply find a new, less visible place to call home? We're about to see why the medicine of a ban so often makes the disease mutate. Okay, let's dive into our core concept here, the hydraulic market. I want you to think of speculative pressure not as a fire you can just put out, but as water flowing through a really complex system of pipes. See, you can block one pipe, sure, but that water has to go somewhere, right? So when a regulator shuts down an official transparent channel, that pressure doesn't just vanish. It searches for the path of least resistance. And a lot of the time, it ends up bursting right through the floorboards into unregulated and, frankly, far more dangerous territory. In India, this redirected pressure has a very specific name: Dubba trading. It's this massive shadow market, an illegal off-exchange system where all the deals are settled in cash. There's zero oversight, absolutely no investor protection, and it all operates completely outside the law. This is where that speculative energy flows when it has nowhere else to go. And the scale of this shadow economy, it's absolutely staggering. Now, it's impossible to get an exact figure, but some unofficial estimates put the annual volume of Dubba trading as high as 10,000 crore rupees. That's over $1 billion. This isn't some small little side market. It's a massive parallel financial system that's just thriving in the dark. And this table just perfectly illustrates the real cost of a ban. I mean, look at the difference. On a regulated exchange, you've got SEBI watching over things, investor protection is guaranteed, and taxes get paid. In Dubba trading, you get none of that. You get zero recourse. The activity simply shifts from a transparent, protected system to one that's opaque and incredibly dangerous. So the really crucial question is, why does this happen? Well, it all boils down to this fundamental conflict between the rules that regulators write and the basic human incentives that actually drive markets. What's really interesting is that this isn't some new revelation. India's own Forward Markets Commission said it a long time ago. Speculation itself isn't the bad guy. It's actually a vital part of the market. It provides the liquidity that lets businesses and farmers manage their price risk. The real problem is manipulation, which, guess what, loves to grow in these dark, unregulated corners. The core mistake regulators make is often a behavioral one. They have this hope that by banning a speculative tool, they'll magically force everyone into proper, long-term investing. But that's just not how people work. The desire to protect your crop from falling prices, or the desire to profit from a bit of volatility, that doesn't just disappear. It finds a new and usually much riskier outlet. And these bans create real victims. Farmers, for instance, lose the ability to lock in a fair price for their crops, which leaves them totally vulnerable. Retail traders get lured by promises of huge leverage and are pushed towards these illegal apps where they can lose everything with absolutely no legal comeback. Meanwhile, the government loses tax revenue and the entire economy loses a clear signal on prices. It's a lose, lose, lose. Okay, so if just banning things fails, what's the alternative? Well, instead of fighting against market realities, a much smarter approach is to work with them. So let's explore what that kind of framework might actually look like. A huge part of the problem is that the regulatory toolkit is basically stuck in the past. Back in the 1990s, when traders were all shouting at each other in physical pits, a ban could actually work, kind of. Information was slow, alternatives were few and far between. But today, we live in a global, digital, zero-latency world. Capital zips around the globe in microseconds, and it will find any crack in the regulatory wall almost instantly. So, a modern approach has to be different. Instead of trying to outlaw a behavior, it should aim to channel it into the light. That means prioritizing disclosure over prohibition, making sure everyone can see the risks involved. It means empowering investors with education, not treating them like children who can't make their own choices. And it means harnessing all the information that speculation provides to make markets more efficient for everybody. This all brings us to what I think is the most important takeaway from our entire analysis today. It's really about fundamentally changing how we think about the role of regulation in the first place. Here it is. Markets are incentive processing machines, not rule-following machines. You cannot just command a market to be stable. You can only design a structure where the natural incentives of everyone involved, the farmers, the traders, the consumers, all lead towards a stable outcome. Any rule that ignores those incentives will always be broken, bypassed, or just made irrelevant by that hydraulic pressure of the market itself. And that leaves us with a final, kind of provocative thought. Maybe the true goal of a modern regulator shouldn't be to kill speculation or pretend we can eliminate risk entirely. Maybe, just maybe, the goal should be to build a system so transparent and so fair that risk is managed properly, and the people who choose to speculate are the ones who bear the full consequences of their own decisions without taking everyone else down with them.